Behavioral insights on culture and wealth. What is culture? Does it affect our beliefs, our feelings, our values? Is an awareness of the culture that clients come from important? Does culture even matter? We'll be hearing answers to some of these questions from none other than Meir Statman. And to moderate this session, it is my pleasure to invite on stage Paresh Thakker. Paresh is managing partner at ValueQuest Capital, a SEBI-registered investment advisor. Paresh has experience across various types of investments, listed equities, minority private investment, and buyout investments. He has served on the investment committee and advisory boards of many leading private equity firms. Let's welcome Paresh with a round of applause. And Paresh, I have to mention to you that last night I was chatting with Meir's very lovely wife. I wanted to get the pronunciation of his name correct, and then she told me the meaning of his name, the Hebrew meaning, and apparently it means the one who gives out light. Oh. I'm sure this session is going to be very enlightening.
Thank you, Sonia. Thanks, Sonia. Well, thanks for joining me today. Thanks, Sonia, for the nice introduction. You've done half my job of introducing Meir, but I'll do the rest. It's actually a great pleasure to have Meir over here. He's the pioneer in the field of behavioral finance. He's one of the foremost authority in behavioral finance, and there are many among us who have drawn inspiration from him. Yesterday night over dinner, I met Rajendra Kalur. I met Hansi, she's over here, and both of them were sharing that how much they learned from him. I also learned a lot from many of his papers, and I'm excited that he's going to share his thoughts with all of us. Meir has got so much of recognition, I don't know where to start, but I'll just highlight a few of the things that he has kind of been recognized for. He's been named as one of the 25 most influential advisors globally by the Investment Advisor publication. He's got many awards. He's got the Graham and Dodd Award thrice. He's got the IMCA Baker Award thrice. And he's published many papers. He has written a few books. His most recent book is The Finance for Normal People, and I urge all of you to read the book. Today, Meir is going to share some of the thoughts from his books. Sonia gave us a highlight of that. And I think the main concept that Meir is going to touch upon, and I'm excited to listen to him, is that Meir brings this concept of normal people. Meir says that the traditional finance talks about rational people. The first generation of behavioral finance talks about, so to say, irrational people. And he says most of us are normal. Of course, all of us believe that we are normal. And he brings that nuance very well in his book. And we are excited to kind of listen to Meir. Meir, I would welcome you to the stage. Please join me in welcoming him.
Thank you, Paresh, and good afternoon to all of you. I am truly, truly delighted to be with you.
It's easy to miss things, to overlook things that are right in front of you. It's part of the human condition. Let's assume that you read through your insurance contract, and being the meticulously cautious, I want to know what I'm covered for kind of person that you are, no doubt that you would have. Could you have missed something important? Overlooked something amidst the Latin clauses and the different sections, subsections as well? Yes, no, maybe. Now, based on your answer and our aforementioned flawed human condition, what if I told you that Floyd's uniform has changed 4 times while I've been talking to you?
All right. How many of you have noticed that Floyd's uniform has changed during that video clip? No one? That's fine. Let me just take it back for a moment. Can you help me? Oops. Okay, let me. Now watch Floyd.
it's easy to miss things, to overlook things that are right in front of you. It's part of the human condition.
All right, have you seen that? The point I want to make with this video clip is that we are human, we are normal people. Our brains are not computers, our eyes are not video cameras. We cannot rerun the tape. We are intelligent people. What intelligence means, in part, that we jump to conclusions, that we use intuition. So computers go A, B, C, D, and then very fast, systematically to M, which is the right answer. People go A, B, C, D, we see a pattern, and we jump. And generally, we jump to the correct conclusion. We jump to M, but sometimes we fall short and we get to L. And so intuition is a wonderful thing, but it is not infallible. And so intuition means that we take shortcuts to an answer, to a solution, but sometimes those shortcuts, cognitive and emotional shortcuts, become cognitive and emotional errors. And then the question really is, how can we do better at getting to the right answers? I'm sure a very reasonable man. I hope that you're laughing because it reminds you about something in your life. So the man used a shortcut. All he wants is to get to work. He remembers where he parked his car. He remembers the shape of the car under the snow and ice. And he jumped to the conclusion that this is his car, and so he started to scrape. So he judged by similarity. It is similar to his car, and so he concluded that it is his car. Of course, in hindsight, he says, that was stupid. I should have first clicked that clicker and found that this is indeed my car. But if you are like most people, like all people, you know that hindsight is not foresight. And you learn from their experience. And second, you, I hope, forgive yourself for being stupid this time. You know, we are intelligent people. We learn from experience, but we are not perfect. So I talk about 3 kinds of benefits that we get from all products and services. So I'm going to give a gift to my beloved, and I wonder whether it is going to be a red rose or $10, which is the price of that rose. I'm a rational man who knows a bit of finance, so here's my thinking. A rose has no utilitarian benefits. She cannot eat it, she cannot drink it. It's pretty much of a nuisance. She'll have to look for a vase to put it in. After a few days, the petals would drop and she'll toss it out. Now, $10 are not a rose by any other name. $10 she can put in her savings account, the one that will pay for nursing home when she's old. And if she wants to spend it now, what do I know of her utility function, as we rational economists call it? Maybe what will maximize her utility is a large frying pan. Well, we all know that this kind of thinking may be rational, but it's pretty stupid, because if I actually followed through on this script, surely I would not be her beloved, because we know that while roses have no utilitarian benefits, they have a lot of expressive and emotional benefits. A rose says, I love you. A rose says, I'm a thoughtful man. You'll do well to marry me. Imagine me instead at her doorstep on Valentine's Day holding a $10 bill. Well, the point, well, let me first show you what happens. Exactly. Yeah, if, sometimes people have to get bumped over the head to get the point. So one of the things that I want to convey to you is that while you call yourself wealth managers, I call you well-being managers, because wealth is only a way station to well-being. And well-being is when your utilitarian benefits are delivered. Risk, return, you want to get enough money. But what is the money for? The money is for buying food and shelter and so on, but also for expressive and emotional benefits, just as in the case of that rose. And the point I want to make and emphasize to you as well-being managers is that you better be well-being managers, because if you focus on wealth management alone, you're going to be annihilated by robo-advisors. They do that stuff of asset allocation, blah, blah, just as well as you do. This is not your relative advantage. I am a consultant to Wealthfront, one of the robo-advisors in the United States. And Andy Ratcliffe, who started that company, says that he wants to do to financial advisors, to wealth managers, what the internet did to travel agents. Pretty much get them out of the business, or at least get them out of the business of ordering tickets. Now you use travel agents, but you use them when you need something that is complicated, to get a full itinerary, to get a cruise or something like that. That applies to wealth management as well. So what is it that we want? What is it that money is for? Well, money is for utilitarian benefits of supporting our children. I have money to support my children, but I also express myself as being a responsible parent and one who is proud, getting the emotional benefits of knowing that I am supporting my children. Now, I'll say a word about culture. So, children expect parents to invest in them, and parents expect a return on their investments, but the nature of the return varies across countries or varies across cultures, and it varies among families in each country. One of the pieces of information that I believe I gleaned from conversations with some of you is that what it means to be in a family is changing in India. India is relatively collectivistic rather than individualistic. And in individualistic societies, people are responsible for themselves, their spouses, and their minor children. In a collectivistic society, people are responsible for a much broader family, elderly parents, brothers and sisters, cousins, friends, and so on. And in collectivistic countries, very often the pension funds of parents are their children. That is, they raise the kids, and then they expect the kids to support them in retirement. Well, that is changing. That is changing in India, and now people, in fact, are saving for their retirement rather than say, when I retire, my kids are going to support me. And culture is like air. we are breathing it, but we are not aware of it immediately. And so many times in conversations, we are in those situations of the chicken and the duck. That is, we come to things like subsidies that China provides to some of its manufacturers, and that is thought in the Chinese culture as being perfectly fine. That is what government as parent is doing for companies, its children. But in the United States, those subsidies are the equivalent of letting some runners begin the race before other ones. And if you don't get to it and understand those differences in culture, you really are going to be speaking past each other. And we all care about status. Social status matters to all of us, but it varies from country to country. In China, my students from China will tell me it is fancy cars and properties abroad. In the Persian Gulf, it might be big cats and so on. I will not try to tell you what it is in India. I do have students from India, and so I have my guesses, but I think that, of course, you know that much better than me. And so people care about status. One of the status symbols in the United States is hedge funds, or alternative more generally. You see, so I don't know, again, the particulars of India, but in the United States, not everyone can buy a hedge fund. You have to have at least $1 million of assets, and you have, or an income of at least $200,000. And minimums of hedge funds might well be in the millions. And so, kind of meeting somebody and saying, "Hi, my name is Meir Statman, and I'm a rich man," that's gauche. But if you're talking about investment, you can drop a hint that you are into hedge funds, and so I've learned the same thing. In the United States, at least, hedge fund managers make tons of money, billions. Shareholders, investors, do not, okay? So what do hedge fund managers do with their money? Well, they buy expensive paintings. The one on the left was bought by Ken Griffin of the Citadel hedge fund for $80 million. And the one on the right, of course, is one of my paintings. Now, you might say that the one on the left is more beautiful than my painting, but I would like to point out two things. First, my painting has more colors. Second, unlike this fellow Jasper Jones, I can draw straight lines. One of the places where they really tell you that you are not first class is at the airport. You know, are you first class? You go in first. You have better seats. They treat you well rather than, you know, send you to the back of the airplane. And so this is, of course, taking a humorous look at it, but you can see the point of it. So as Paresh mentioned, I talk about the second generation of behavioral finance. In the first generation, or in standard finance, people are rational. In the first generation of behavioral finance, people still want the things that rational people want, which is high returns, low risk. But they make mistakes about it. For example, trade too much and lose returns. In the second generation, people want to satisfy their utilitarian, expressive, and emotional benefits. You begin with wants. Yes, we do make cognitive and emotional errors, but we make them on the way to what we want.
You mean not good, like 1 out of 100?
I'd say more like 1 out of a million.
So you're telling me there's a chance? Yeah! I read it.
So if you think about lottery tickets, this is an excellent example. In standard finance, people, rational people, don't buy lottery tickets because they have a negative expected return and high variance around it. In the first generation of behavioral finance, people buy lottery tickets because they are bad at math. They don't understand the true odds. In the second generation, people buy lottery tickets because they can express themselves as players with a chance of winning. They get the emotional benefit. We get the emotional benefits of hope. And we have a chance, however minuscule, of winning many millions of dollars. Now, you can see then that, suppose that I told you that the true odds of winning if you bought a lottery ticket are not 1 in 100 million as you thought, but 1 in 200 million. Will it cause you not to buy? Probably not. So it is not a matter of getting the math wrong. It is a matter of people in standard finance don't understand how valuable hope is in all our lives. And so in my book, I try to address a kind of a common complaint about behavioral finance where people say, well, it's nice stories, but it does not have the heft and the rigor and the comprehensiveness of standard finance. And to that I say, nonsense. They have rational people, we have normal people, we have behavioral portfolio theory and life cycle theory and asset pricing and notions of market efficiency. Let me speak briefly about portfolios. So here's a question to you. If you could increase your chances of having a more comfortable retirement by taking more risk, would you? And you have a choice between A and B. A is be willing to take a little more risk with all your money. B, be willing to take a lot more risk with some of your money. How many go for A? How many go for B? You are normal people. Think about it for a moment. Taking a little more risk with all your money adds to your risk in the portfolio about as much as taking a lot more risk with some of your money. So why is it that people are so overwhelmingly preferring B to take a lot more risk with some of your money? My point is that this is normal behavior. People do not look at their portfolio as a whole, as Markowitz recommended, and choose a point on that efficient frontier. Instead, people think about it in terms of mental accounts. And by the way, just to let you know, Harry Markowitz, of course, who is extremely well known for his portfolio theory, and I and two of our colleagues, we wrote a paper about a mental accounting framework for portfolios. So Harry Markowitz knows normal people very well. So the way I describe it really is that I go to an advisor who looks at my assets and looks at my goals, and he says, Meir, I have very good news for you. You have a 90% chance of achieving all your goals. So I go home to my wife and I say, I just learned that there's a 10% chance we're going to live in the street. Imagine instead if he divided my money into downside protection money, maybe in bonds, maybe insurance, and upside potential, maybe lottery tickets, maybe lottery stocks, maybe growth stocks, Now I go home to my wife and I say, we are going to be fine. We will have all we need to live comfortably in retirement. And on top of that, we have a 10%, 20% chance to leave a lot of money to our kids. And so one of the things about behavioral portfolio theory is that instead of having the mean variance efficient frontier that is governed by risk and standard deviation, I have something that I call behavioral wants frontier. And so if somebody is a socially responsible investor and is willing to sacrifice some returns for the benefits, expressive and emotional benefits of being socially responsible, that person is not stupid. That person is not irrational. That person simply has wants that many do not share, but that person does. Life cycle. So the usual story is that you save during your working life and you then spend in retirement, and the best outcome is that you spend your last dollar on the day you die. But that really is not how people do it. First, people derive expressive and emotional benefit from just sitting on money. Okay, it feels good to have money, even if I'm not going to use it, because people give you respect. Second, people have trouble saving and spending. You know, it is really hard to exercise the self-control that is necessary. And so what we do, normal people, conscientious normal people, responsible normal people, we engage in framing and mental accounting and self-control. That is, we frame money into accounts of this is capital and this is income, and then as if there are two different kinds of money, and then, so we have them to those mental accounts, and then we have a rule that says, don't dip into capital. Spend income, but don't dip into capital. So it is a self-control rule.
I'll tell you a story about Dusty.
I know what you're going to tell about the money you lent me. I know you tell us
It's
some
such
story.
a funny story, I think. I go over to Dusty's little apartment in Pasadena one time, and he says, hey, can you loan me some money? Yeah. My wife was working. I wasn't working, but my wife was working. So I said, how much do you need? He said, I don't know, $5 or whatever. And
more than that.
So I go into his kitchen, and he has these mason jars up on a ledge. And one of them says rent, one of them says entertainment, one says books, one says about 5 of them, all labeled.
Electric.
And they all had money in it, except the one that said food. And that didn't happen to have any money. So I said to him, well, you don't need any money, you got money. He says, I can't take the money out of the other jars. I think your mom probably told you that was the way to...
That's right. Or my father.
So, you know, some of us do it with jars. That is old-fashioned. Some of us do it with Excel sheets. Some of us just do it in our heads, but we don't look at all monies as being fungible. We save by using those kinds of rules. And by the way, people in the retirement here find it really difficult to break those habits and dip into capital. They might have a lot of money in their 80s, but they still insist on living on dividends and interest. So I'll talk briefly about what it means. People are normal, and about notions of market efficiency. First, let me say something about notions of market efficiency. And I heard in the session before me the note that active funds, active management is growing faster than passive one. That is not the case in the United States, and it might not last in India either. People are wising up to the cost of active management and the futility of it. And so the way I think about the market is like this pot of stew that has fat and lean in some proportion. And remember, it's not the financial services industry that makes those returns. Those returns are made by the economy. It's made by companies. All the financial services industry does is allocate it among people. And so if I have an index fund at a very low cost, and mines are 4 basis points per year, I put in my ladle into this pot, fish out fat and lean in proportion to the pot, and that's what I have. So I get average returns. If somebody gets above average returns, somebody must be getting below average returns. Naive investors, informationless investors, are not likely to be among those that get above average return, other than by luck. And remember, I call it market sum game, because sometimes you get people calling the market a zero-sum game and then say, gee, if a market goes up, then all of us win. Well, that is true. But we cannot all be above average. Okay? And so that is something that people find hard to get. Why is it that people find it hard to get? Ignorance, cognitive errors, and wants for expressive and emotional benefits. Some people, for example, will say, oh, I made a lot of money last year. I made 20%. Well, they seem to be unaware that the stock market increased by 25%. Okay, and so they don't compare it to the market. Or some people don't realize the losses, and they say, well, if I didn't realize it, it's not really a loss. Then there are cognitive errors. That is, people frame things wrong. People will say, I sell my stocks because stocks are sure to go down. And I always say, in every trade, there is an idiot. And if you don't know who it is, you are in trouble. So you always have to think about it. This is not tennis against a training wall. This is tennis against possibly a Roger Federer on the other side, or Warren Buffett, or Goldman Sachs, or whatever else that have information you don't have. Here's a question to you to get to this issue of overconfidence. So do you think that your skills at juggling 3 oranges place you above or below average among amateur jugglers of your age? How many of you think that you are above average in juggling 3 oranges? How many of you think that you are below average? More of you think that you are below average. How about driving? How many of you think that you are above average drivers? How many of you think that you are below average drivers? Okay, you are very normal. How many of you think that you are above average in picking investments with extraordinary returns, beating the market? How many think that you are above average? How many of you think that you're below average? And about equal numbers. So here's what I'm telling you. The kind of old wisdom in behavioral finance that is built really on very old literature and psychology is that people are overconfident in driving, and therefore they're also overconfident in beating the market. But that is not the case. People are underconfident in difficult tasks like juggling oranges. People are overconfident in easy tasks like driving. And when it comes to beating the market, in fact, on average, half the people think that they're above average and half think that they're below average. So they're not overconfident. And so the reason people get themselves into trading is not so much that they are overconfident, but because they forget the first one. They forget that this is tennis against possibly Roger Federer.
Hey, there's a space.
What are you doing?
Reversing.
I'm the king of reverse.
Really? I could reverse from here to Cape Town if I wanted to.
$50 says you can't.
Yes, it is true. Men are more overconfident than women, and especially young men. And some people who are traders, who are frequent traders, fall into this category. And so 62% expect to beat the market, 29% are modest, just expecting to match it. Hindsight, it was mentioned before, it's a dangerous cognitive error. If you just look at how bad forecasters of the markets are, you just have to look at what they did at the end of 2007. They, on the whole, expected fabulous returns in 2008, and of course we know what happened in 2008. And then people want expressive and emotional benefits that lead them into attempts to beat the market. There are issues of pride, there are issues of regret, there are issues of hope and fear. With an index fund, you know, you're going to be average or a bit above average because some idiots are going to spend a lot of money on trading and so on. But you know, you want some hope. And so if you want hope, that's fine. Remember that kind of pyramid portfolio. Buy a few lottery tickets, buy a few lottery stocks. That is fine. Just don't put your hard-earned money, the money that you need for real things, this way. And so fear, you know what fear is going to do to you. You have to be able to step away from yourself and ask yourself, is this fear really justified? So let me just conclude again by bringing it to those notions of the people as rational. In standard finance, people are as irrational in the first generation of behavioral finance, and people are normal in the second generation of behavioral finance. Thank you all very much.
Thank you for the insightful presentation.
Thank you.
As Sonia described, that you will throw a lot of light. So, you know, you said that men have a tendency to be overconfident. We all know it. You know, Daniel Kahneman in his book has also made a reference to overconfidence. And he's also said that, you know, as much as we label all these behavioral patterns, it doesn't help us much to recognize catching ourselves, you know, in action. It's easier for us to see others, you know, in action and seeing them into patterns. Do you agree with that? And if you agree, would you advise that investment managers shouldn't operate in isolation and they should operate in teams?
Well, yes, but let me begin with whether you can see it or not, or whether you can see it in others and not in yourself. It is generally true that people are quicker to note the stupidity of other people than their own stupidity. But people do learn. We are intelligent people. And so whenever people tell me, oh, that was obvious, everybody could have seen it, I remember hindsight. You know, I remember that it is easy when you get to the end of the mystery novel to say, gee, you know, I should have known that this person was the murderer. There was already kind of a very broad hint of it on page 2. But of course, you didn't see it until you got there. And so if you kind of remind yourself that you are subject to those cognitive errors, that is a good beginning. But absolutely, in a team, if you make a mistake, then somebody can gently, without suggesting that you are stupid, just say, wait a minute, have you considered that? Are you aware of that? And so in this sense, whether you work as a team or whether you just ask your husband and wife or wife to give you an opinion, you're going to make fewer errors than otherwise.
Thank you. We have an interesting question from the audience. The question is that since humans are prone to behavioral errors, would it be more efficient to use, you know, quantitative models and reduce the human involvement?
Well, yes, And no, I mean, we cannot really do quantitative method of everything. But one of the things that quantitative methods do, for example, regression. Regression analysis forces you to look at all the data rather than anecdotes. So you cannot really kind of have a rule that says, gee, you know, on Tuesdays prices of stocks go up, and on Thursday they go down. And here are some examples of this happens. And if you have a case where on Tuesday they went down, you say, that was a fluke because the Fed said something or something like that. Well, if you have a system, a quantitative system that does not allow you this kind of confirmation error, then you're going to benefit. And that is possible in money management, and so I highly recommend that. It is not possible in each and every decision in life.
You know, if suppose one, you know, assume I'm a wealth manager, and if one of my clients has read your book, after reading your book and presentation, you know, going through a presentation, he says he wants to buy that $80 million painting. And, you know, and he says that, you know, that is part of his expressive wants and his emotional want, because he's the Indian, you know, Ken Griffin over there. But me as a wealth manager, I feel that, you know, it is probably out of his bounds. How should I operate in that situation?
Well, you know, I was asked in another presentation by someone who is managing a family office of somebody who is exceedingly wealthy, who has more than $100 million. And he had a 5% money of that money as his play money, where he can kind of play on hunches and so on. And he wanted to have 15% of his money to do that. And I kind of hesitated for a moment, and I said, you know what? Suppose that he loses the entire $15 million. He still has 85. So, you know, if you are rich, you can be stupid, and you'll still remain rich. And so it kind of depends. You know, if you are going to be gambling your children's college education, don't do it. If you are going to gamble 15 million out of 100 million, you know, do whatever you please.
This is a question from the audience. Everybody talks about importance of diversity for a business to succeed, but nobody really does that.
When you say diversity, are you meaning?
I'm assuming it means diversification, you know, of portfolio, or diversification as an entrepreneur. Well,
again, you know, if you look at people who are exceedingly successful, these people did not diversify. That is, if you look at people like Bill Gates, you know, he didn't diversify. He dropped out of college, very irresponsible, and he started a company whose fortunes were not at all clear at the time. But now we look at it and we say, see, that is what you should do. You should drop out of college and you should start a company. Or you should put all your money in one stock, and if it is the next Berkshire Hathaway, Warren Buffett's company, then you're going to be really, really rich. Well, that lets us see the very successful people who made it, but we don't see the unsuccessful one. And so there is, in fact, a book that I read recently about a woman who is 55. She actually was a professional. She accumulated a good amount of savings, and then she decided to invest it all in a store selling African artifacts. And it didn't work, and so now she is fallen into poverty. And so, you know, you have to ask yourself, if you are at 25 and you open a store and it does not work, well, you still have many years to catch up. But if you're 55, you cannot. And so here an advisor is going to say, wait a minute, are you really sure? You know, you want to be able to support yourself, you want to be able to support your children, and so on. Yes, I know that you always wanted to be rich, but now, how about if you define rich just having enough to retire on?
Thank you. You again, another question, good question from the audience. Do you think that passive investing across the globe, and even in the context of US, is leading to kind of huge flows into large cap ETFs, and that is kind of leading to a surge in the market because it's not, the stocks are not being selected, it's just the flows?
Well, I mean, there are index funds. The index funds say the US stock market index fund has both large stocks and medium cap stocks and low cap and small cap stocks. And so you don't need to do that. If you have international, developed markets, and developing markets, you have a bit of India, a bit of Belgium, Australia, and everything else. I mean, if I look back, I see that my US fund has done a whole lot better than my international fund. But I remind myself that diversification is just that. That is, when you diversify, you give up hope of having all your asset in the winning asset, and you avoid the risk of having all your portfolio in the losing asset. And so I kind of shrug and I say, you win some, you lose some, but on average, you're still doing fine in terms of your financial goals.
One last question, we run out of time. You gave us advice that we should take second opinion from our spouses, second opinion from our business partners to reduce our errors. Any other advice to reduce our cognitive and emotional errors?
Well, as I said, the first line of defense is to be aware of those cognitive and emotional errors, to have kind of a sense of humor, which means a sense of proportion. Sometimes you will get things wrong, and the ability to really, using the language of Daniel Kahneman, to engage system two, to say, wait a minute, Now, if it is a matter that you are in a restaurant and you have to choose between chicken or beef or fish, and everyone else has already chosen and the waiter is waiting for you, just go by your gut. You don't really need to make a big choice. But if you're going to have a decision like should I take all my savings and open a store when I'm 55, or what career should I choose, and so on, it is something where the consequences of making the wrong choice are very serious. And so pause, think, consult, and then make your choice. Don't let system one, don't let your gut make the decision for you.
Thank you.
Thank you all
Thanks
very much.
Thank you.